What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome to another episode of the CPA Zone. Today, we're going to talk about a particular court case. It's from several years ago, 2014. This is a case called VanMalssen v. Commissioner. It's Tax Court Memo 2014-236. And what it covers is the personal use of a rental property. What constitutes a personal use day? As many of us are probably aware, there is an exception for days you work on the property. We're going to get into a little bit about that. That is covered in this court case. And this comes up really due to a number of questions regarding short-term rentals. The short-term rental loophole: buy property, rent it out for the period of customer use is an average of 7 days or less. If you buy late in the year, run a cost seg study, take the accelerated bonus depreciation, self-manage that first year, you can end up with a significant year one write-off, and you don't have to qualify as a real estate professional. So a lot of people that try this strategy, many of them will buy a property that they also want to use personally, which can blow up your whole strategy. So basically, the best approach that first year when you're going to take the write-off is not to use it at all, no personal use. But this court case kind of goes into the details around what constitutes personal use. So let's get into it. A little background about this case. So we have the taxpayers, VanMalssen. Husband and wife owned a vacation condo in South Carolina. They lived in, I believe it was Virginia. So they rented this property out, also used it personally. And the court case covers tax years 2008, 2009, and 2010. Each year they claimed losses from the property. The IRS selected the return for examination and disallowed some of these under the Section 280A, which this is the area of the IRS code that governs the personal use of any property of a residence. So under 280A, your deduction for rental property expenses are limited if you use the property for personal purposes beyond a certain threshold. That threshold is the greater of 14 days or 10% of the fair rental days of the property. So that becomes key in this court case here. Another topic they talk about is travel days and how are travel days classified. So, for example, they were driving from Virginia to South Carolina. They'd get there and spend the night. They'd sleep and wake up and then start working in many cases. So what does that day they arrive count as? How's that counted? Because that basically all they did was travel. And then also they had a relative, one of the taxpayers' brothers, use the property a bit, and we'll look at how that impacts your personal use days. So at a high level, what the rule is a personal use day is any use by you or a qualified relative. So that's going to be most of your family members. In this case, we were talking about the taxpayer's brother. Now, a qualified relative, when a relative uses your property, it is considered a personal use day, even if they pay you fair market value rent. The exception would be is if they're using the rental as their primary residence. So in this particular court case, the taxpayer's brother used it for, looks like 7 days out of the year. Those 7 days were considered personal use days. Another topic that they covered were repair days. So what does a repair day count as a personal use day? And generally, a repair day is not going to be considered a personal use day as long as the taxpayer spent the day substantially working full-time on the property. So working at the property on a substantially full-time basis, doing repairs and maintenance. And generally, that's going to be at least 4 hours, could be up to 6 hours a day, somewhere in that range. So if you're spending in the neighborhood of 4 to 6 hours a day working on the property, then that's going to not be considered a personal use day. And if you go with your family can spend the day doing whatever they like, relaxing, as long as you're doing the work. or maybe you get to relax and your spouse does all the work. Either way, either the spouse, and if it's a joint return, or I'm sorry, the taxpayer, or if it's a joint return, then the taxpayer spouse, one of them has to be doing a substantial amount of work during the day. And again, it's going to be like at least 4 hours, anywhere 4 to 6, and you're going to be okay. So those days, if you're doing repairs and maintenance on the property, they're not going to be considered personal use days. Now, in this case, the taxpayer did do quite a bit of maintenance. They would travel down. The husband would travel down. He'd stay for a number of days. Some trips he spent every day working, he met the 4 to 6 hours each day. He did keep good time logs and tracked his time each day. That's very key. The tax court reviewed his logs and found them credible. That weighed heavily in his favor on many days. But then his logs also showed certain trips he would have personal use days. He'd go down, work for a few days, and then spend a few days relaxing. Which brings us to the next point was, do travel days count as a personal use day? And what we've learned here is travel days will be considered personal use if the primary purpose of the trip is not for repair and maintenance work. So if you go to your property and spend most of your time, half your time personal and half business, they're going to say the primary purpose was not for business or repairs and maintenance. It was personal. So the travel days are going to be considered personal use days. And again, travel day being you travel to the property and get there, you're not doing any work. That is going to be a personal use day unless the primary purpose of the trip was to perform repairs and maintenance. And we can see from several examples in this case, that means the number of days spent primarily doing repairs and maintenance are greater than half the days of the trip. So if you're there 5 days and you spend 3 days repairing the property, then your travel days are not going to be considered personal use days. They're going to not go against your count of personal use days. However, if the primary purpose of the trip is not for repairs and maintenance, then those travel days are going to be considered personal use days. So if you travel to your property and stay there, and the primary purpose of the trip is deemed personal, those travel days are also going to be considered personal. And that got the taxpayer in trouble here because several of the trips, the primary purpose was not to work on the property. They were spending more time using the property personally than working. And that shifted more days into the personal use bucket, which in 2 of the 3 tax years ended up treating the property as a personal residence. So they were not able to deduct any losses. I think it was the 2009 tax year. What happened is it shifted some of the allowed deduction. They didn't quite get over that threshold, the greater than 14 days or 10% of the fair rental days. However, some days were changed to personal use, which reduces the deduction because your expenses are limited based on the amount of personal use at the property. So that's in any year. The more personal use you have, the less you're able to deduct. That's another reason why it's important, if you're using the short-term rental strategy, to not have any personal use in that first year, because that big bonus depreciation write-off you get will be limited by your personal use days. So again, just to recap, this court case gives us a good look at what how the IRS treats personal use days at a property. So any use by a relative is considered use by an owner and is personal use, even if they pay rent, unless that property is considered their primary residence. Repair and maintenance days, typically not personal use days. They do not count. However, you have to make sure a substantial portion of the day, at least 4 to 6 hours, is spent working on the property. Any days that you spend not working on the property are personal use. And then travel days will be considered personal unless the primary purpose of the trip is to go to the property and perform repairs and maintenance. In that case, the travel days are not personal. I hope you found value in this episode. That about does it for today. If you liked it, please leave us a 5-star review, hit that like and subscribe button. Until next time, have a great day. One last thing before you go. We have put out a free ebook for our listeners. You can find a link to this in our show notes. It's called the Rental real estate investor tax guide and covers all the basic tax related information for real estate investors. We hope you like it. Again, go to the show notes to download your free copy.
This audio segment was edited by me, Adam Rothstein. If you would like help editing your podcast or narrating your audiobooks, please email me at adamrothstein29@gmail.com. That's ADAMROTHSTEIN29@gmail.com.
So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.